following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
All right, we are back. Let's talk futures. We have Dan Gramza, Gramza Capital Management, joining us live today from Chicagoland area. Dan, good morning.
Good morning, Jim.
How you been?
Good. Life is good. Everything's great, and looking forward to exploring these ideas with you today.
Oh, yeah. I mean, I have so much stuff going through my mind. It's almost like every data point now is kind of more important than it used to be. Did you get the same feeling?
Well, I think the market's getting more and more sensitive to what's happening because the market's searching for an excuse, right? It's always in that forward-thinking excuse mode. So I think the sensitivity to data is probably increased as they search for that excuse. And then the issue is a data point is not a trend. And that's something the market forgets about sometimes. Something may come out and it seems a little high or too low or whatever it may be, but it's not the big picture. It's just a data point.
So, but it's interesting you use the word excuse instead of expectation, right? Excuse to me suggests I have a belief perseverance in a certain direction, and I'm using these numbers as an excuse, but you used it in a different way.
Yes, because I think if you look at gold, gold is a market that I think of as an excuse market. What stimulates that market? Well, it's the perception of value, and it responds to uncertainty, inflation, weaker dollar, global geopolitical situations. It needs an excuse like that to really stimulate that market, as opposed to agricultural markets or something on those lines. It's not so much an excuse, it's more the estimate of what reality may be. The crop doesn't look good. We didn't get enough planted. It looks like there could be warm weather coming. So that's a different situation. And it's reacting to either anticipation of an event or the reality of it. We don't have enough rain. The root systems aren't deep. We could have problems in August with hot weather. It's, that'd be an example for corn. So I think it's just different motivations for a market that we see.
Okay, so that makes sense to me. All these numbers are coming out. I guess there was a big emphasis on employment this week. We have, the jobless, the employment situation, they call it now, which is a better way of saying the unemployment report on Friday. But really, PMI, a lot of folks suggest Purchasing Managers Index is one of these things that actually is a leading indicator. What do you think about that?
Well, I think it can be, because if we think about what does it imply, it implies the purchasing managers, they usually say sentiment, but I think of it as outlook. What are they seeing in the manufacturing sector? Are they buying more? Are they buying less? Is their outlook? If you look at the survey, they get a survey every month, and that survey breaks everything down. So the early warning system idea I think it does make some sense. If we think about first, where does manufacturing fit in? It's about 16% or so, 12 to 16% of our GDP. But it's a critical piece because what happens in manufacturing ripples through our economy. And that goes back to what you said, that early warning type system. So if we see an increase in manufacturing expectations, that they're hiring more people, they're buying more supplies, they're expanding their facilities, we expect that to have an impact on price, which could have an impact on inflation, which could have an impact on what the Fed does. And what the Fed does impacts all of us at some point in that mark in the economy in terms of how the market and the economy absorbs that Fed policy.
So what surprises me, manufacturing, you suggested is 16% of GDP?
Yep, 12 to 16% is the typical range. It's fairly consistent. The largest portion of GDP is service. It's consumer spending. That's about 70%. So
I
what,
see.
yeah, so but is it critical? Sure. I think a lot of people think it's a much larger part of our GDP, uh, but it's an important part. It tells us something about employment trends. It tells us something about supply chains, our supplier delivery times and inventory levels and production schedules for the companies. So it gives us some information there. And something else, Jim, it gives us information about business confidence. What is the outlook again? Are they thinking of expanding? So that's a positive outlook. Are they saying things are going to stay the same? That's okay. And that'd be a number around 50. Or do they say we're going to cut back? We don't see demand for our product line, so we're going to have to shrink our operations. So that business confidence is reflected in that. And then I think it also reflects investment decisions. If an investor or a trader sees a market sector in the manufacturing area that's really taking off, well, it may stimulate them to buy that. And that can add some momentum to that particular market as well as attention. So it has an impact there on investment decisions. And and the Fed, as we talked about, that the Fed watches this and they want to know, are things heating up? And one of the places that can cause the economy to heat up is manufacturing. So they're going to keep our eye on that.
Yeah, no, no doubt it's important. There's no doubt it's important, and in my mind, manufacturing is related to everything, right? So if you a potato on your dinner plate, there's a whole supply chain of things that need to be manufactured to get that potato to your dinner plate, right? So it's this kind of, it's a direct relationship on everything we buy, I think, even to some extent in the services side.
Yes, yes. So this PMI number, depending on what you think about manufacturing, has an impact on commodity prices. If their production increases, that means demand for those supplies that they utilize is going to increase. And that also can add to inflation. So, and then we can take it a step further. And we're not the only country that uses this barometer. We can look at other countries. What are their outlooks? What are they contemplating down the road? Are they shrinking? Are they expansionary? What's happening on that regard? So it's not only for us, but it also gives us a comparison to other countries as well.
So that's an interesting point because there seems to be two organizations now that kind of focus on these services and manufacturing PMI. We have the Institute of Supply Management, which focuses here in the U.S. It's been around since 1910, if you could believe that.
Yeah.
And then you have S&P Global Platts PMI, which is international, right? That's been around since 1990. So you have a couple of different organizations that measure this through surveys.
That's correct. The ISM, they have 50,000 members. They operate in 100 countries, so very broad. And the S&P Global numbers, they also leave something out. They're a little different in terms of what they contemplate. Generally, it's the same idea. And I'm trying to think of what it is. It's not a major difference, but it is a difference between the two. But they both give us these measures, this outlook that we're talking about here.
Right. And is this a diffusion index? It's above 50 or below 50? Is that the correct?
Yeah, if it's above 50, expansionary, and below 50, it's contraction. So it is that type of index.
All right, so let's take a look, if we can, on my screen, Mission Control. I have a real quick chart up here. This is the ISM Manufacturing PMI. So this is the Institute of Supply Management number that just came out. And, I'm not going back too far in time, but I just found this chart pretty easily on this website. And we've been below 50, since June of 2023, probably before that. I don't have data going back that far, with one kind of positive 50 number in March. So this has been contracting for a while.
It has. It's been soft. And, it's one of the things that the Fed looks at. If it starts to increase, then it goes back to that snowball effect of how it impacts so many other things. Employment, Fed's concerned about employment. Inflation, high numbers here imply the possibility of adding to increasing prices, therefore inflation. And right now, it's kind of steady as she goes. Is it dramatically lower? Not really. 46, I mean, it is low, but it's not dramatically lower. So it's, not really contributing something where I think the Fed says, whoa, manufacturing is, we got to watch that. Because it's not only what happens with that number today, remember, it's the outlook. So it's a forward thinking number. What do we expect in the future when you look at this number? That's what it implies. And that's the interesting part of this survey.
Yeah, but so it's not like a cumulative effect, like contraction, 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 contraction. That's not, I mean, is the trend important or no? I mean, the below 50 trend, or just, well, we're sideways now and everything is good?
Well, it is important because it does say something about employment. It says something about demand for the supplies that these purchasing managers look at. It may say something about supply lines. Maybe there's a problem, and that's why this is so soft in terms of staying below 50. So there's a number of variables at work here when we think about that part of it. And so I would say it is stable to an extent, but it could be troublesome because, again, the outlook aspect is going to have an impact on employment. And the Fed, one of their jobs is to try to keep full employment. And is that going to be a problem for them?
Got it. That makes sense, right? And I just found the component section here, right? It's manufacturing backlog of orders right off the bat. That seems like a big one. Employment, inventories, new orders, prices, production. So there's and supplier deliveries. So there's from a manufacturing point of view, these are the key points to hit.
Correct. They all come together to support that sector. And what's the impact on that? And how much, where are these companies? Are they all out? maybe they're manufacturing at their largest capacity. Is that what we're seeing? Or are we seeing companies that really have a ton of room to produce more?
Well, you just opened the door for capacity utilization, so I'm going to pick up on that.
Yeah, it
If
does
if
actually.
if we could kind of move over now, this is a Federal Reserve uh, kind of report, right? So I found
Yes.
the Federal Reserve system, and you know their latest report, right? We're going to get another one in obviously coming up, but this is explain how you calculate capacity utilization.
Okay. Well, let's say that you and I are talking to a manufacturer and we say, how many widgets are you producing? And they say, well, we're producing 50. We're producing 50 widgets. And then we ask them, what's your maximum manufacturing capacity? How many can you make? Oh, I can make 100. So you're making 50, you have the capability of producing 100, so you're at a 50% utilization. You're using 50% of your capacity, your manufacturing capacity to produce 100. And now I always think of these numbers, Jim, because it gives us an idea what the wiggle room is. You know, if you look at the late 60s, early 70s, we were operating at 85 to 90% capacity. Oh, there you go. Yeah, 85 to 90% capacity utilization. Hey,
Yeah, yeah,
that's good. And now look where we are now. We're around 80%.
yeah.
So we're lower. Now, is that bad? Well, it could be that companies have a lot of excess capacity. It could be that we became more efficient, actually. So we're using less of our total capacity because of technology, because we've improved things. Now, this also comes into play if this company's operating in the 90 some percent or this industry, then we know for them to expand, that means they're maybe building a new facility. That means they may need, new supplies, more equipment, and more employees. So that changes things. If people are operating in that 90 some percent range, well, to increase that capacity could have an impact on inflation if I'm the Fed, because they're going to have demand for these other areas. So when you look at refineries, that's one to really, when I think of a refinery, this is one of the things I think about. Where are they operating? If they're in the 90 some percent, which is basically all out, they're near maximum capacity. So the only way they can change that is to build more or to increase with technology the ability to increase their production. So this really, I think, is an
We
important parameter.
we haven't built one of those in a while in the
Oh,
U.S.
over 30 years. And we
Yeah,
probably won't. It's the time lag, the cost, and do you want to build a new refinery that'll take years, that will be billions of dollars at a time where everyone says we should be a green economy? Not that that's bad, but if you're going to make that new refinery, will you get a return on capital? Will you be able to justify that increase in expense to your shareholders?
yeah, and with
So
enough
it's,
maintenance and replacement
oh,
focus, you could make these things go and go and go.
well, yeah, and we've increased production by 50%. You know, the industry, the oil industry, refining capacity has increased. We just don't build new refineries. We add new technology and expand existing refineries. So that's where that increase comes into play there. But this utilization, I think, is an important number that we want to be sensitive to when I think about purchasing manager's report. I also think of this.
So, I mean,
I'm
clearly, when there's a recession, this is, we have these big dips in this chart, right? When in these areas that are highlighted as recession. But I think what you're suggesting, though, is, 78, it might be the old 85,
correct,
right?
correct,
Okay.
correct. And it's not necessarily a bad thing. If we have new technology that increased our capacity and we just don't need to operate at 90%, we can do the same production. We can give you 50 widgets, but now we only need to use 40% of our capacity because
Yeah.
we've improved.
Yeah. Well, just to zoom in a little bit on this chart, and then we'll go to we'll go to the crude chart now that you'd mentioned it. It's, I don't want to say flatline, but there's no real huge trend here from 2022 till now.
Yeah, but Jim, think about what you also showed us when we looked at the PMI. I mean, you said, we're not really, we're below 50,
Yeah. Yeah.
right? About a 5-point range. Well,
Yeah.
we also know there's some room here on the capacity side.
Yeah.
So I think they're not unreasonable relationships right now in terms of the charts that you've shown us.
All right. Well, let's go to some real charts. The charts that
Okay,
I understand a little better. We talked about crude right now, and this was a really interesting time. Again, had this head and shoulders pattern that hit today of all days. So we won't get too much into that. But right now we had OPEC. I know we're a little off script. I apologize, but
no problem.
OPEC Plus basically said they're going to extend their cuts, and to me, um, that's kind of saying, hey, we're not going to change our output. It was more about not extending. It was, to me, it wasn't special that they're not. It wasn't special that they're extending cuts. That's the way it's been. That's the normal right now. Does that make sense?
Yes, yes, the market has adapted to this current production level, and the demand has balanced it. See, the issue is not only how much they produce, but how is that capacity, the production soaked up? We soak up around 25 million barrels a day. The second largest consumer, China, is China's consumption demand. It's still huge, but has it picked up the excess capacity, the excess production that we do have? And the answer is no. So this isn't unreasonable what we're seeing here. I don't think. And it's not surprising what OPEC says. But Jim, the thing that's going to be interesting is what members say in the meeting. Do they do it?
So
If you look at
you're
Russia,
being nice, Dan. You're like, who's going to cheat?
right? Yeah. Well, that's another way to say it. I mean, look at Russia. They had 300,000 barrels more than their production quota. So, in other countries, they have their economy they're trying to feed. And so what they say and what they're going to do, totally. In the past, it was terrible. Everybody at the meeting would shake hands and say, yes, this is it. Then everybody goes home and does what they wanted. They've improved that tremendously, but I think it's something we should keep in mind.
Well, yeah. And is there an enforcement mechanism?
Yeah, good point. Good point.
Wow.
No, it's, Scout's honor, I guess, kind of thing.
Yeah.
There is no enforcement.
So according to the reports this morning, and again, I don't have a fact check on here, but the U.S. government is buying more oil today for the SPR. Does that make sense?
Yes, it's cheap. You look at where
Yeah.
we've been for the last few months. You're getting 70 some dollar crude. It's cheap.
Yeah.
If you think about replenishing stocks in that regard. So yeah, buy the dip. That's really what we're seeing. That's fine. I don't see a problem with that,
Okay.
you know.
All right.
And if you think about, are we at levels that OPEC wants? No. You know, ideally, most countries want around $80 a barrel, and some want $100 a barrel to balance their budgets and to do the things they need to do. So yeah, right now, and if you look at it, you look at where your rectangle is on the left side, and actually all the way over to the left. Look at all those wicks or the shadows that you see on
Yeah.
the bottom. So
Yeah.
they're buying the break. That's what it says to us, I think. And so it's consistent behavior that we're looking at, and we're approaching that. So do we expect this to fall out of bed to go to $60 a barrel? Right now, we don't have any indications of that type of momentum. And right now on this daily chart, we're seeing weakness. So there's no reason to be a buyer here either, unless you're trying to replenish your stocks. But from a technical point of view, what we saw start yesterday is continuing today.
Okay. So I just kind of highlighted a couple of
Yeah.
these wicks that you're talking about.
Mm-hmm.
So thinking forward, my expectation then would be we're going to have similar behavior out in here somewhere.
Right. That would be reasonable. And what it also implies, because of that characteristic that we're looking at here, it implies hedging, right?
Ah,
If I
all right.
can lock in lower prices, done. So you get me anytime you get me between 72 and 70, I want to buy some. I mean that, and some of the people my path has crossed, that's what they think, because they need
Mhm.
energy. They need to buy this. And if I can lock in prices going forward right now, based on the global situation, $70 to $72 oil, it's cheap. So and what we're seeing there is, again, what I call consistency of behavior. Every time you went down there, boom, they buy it. Go down again, boom, they buy it. So that's just not speculating. That's because there's one other factor there, Jim, that I think comes into play. If
Yeah.
you and I agree on the idea, as you pointed out, there's wicks on the bottom, right? That they bought the break. The issue is then, if it's at a level where people are just buying to hedge, or at a level where they say, this is so cheap, let's buy, and we expect a trend, there is no trend afterwards, barely, right? So you don't see the follow through, which also implies hedging.
Okay. So, every time we talk, you say something that generates like 100 more questions in my head. But we only have like a little over a minute, so I want to
Oh,
ask you one more question about backwardation, because if you could kind of see on my quote board here, the July is trading at 72.87. The December is trading about $1.40 less, right? So it's in backwardation. It seems like it's starting to flatten out a little bit from the last several months. Is that my imagination, or is that something we should look for?
no, I think that goes back. That's an excellent observation, by the way. And
Okay.
it goes back to the market acceptance of these production levels, the global balance of supply and demand. It's all reflected in what you just said, I think.
Okay. All right. Well, we'll keep an eye on that backwardation phenomenon. And textbooks suggest this might be bullish for the front month. I don't know if that's true.
Well, Theoretically, yes, because that's where the demand is, which is why that premium is there at the nearby months.
Yeah.
So that short term, people want this stuff. And, maybe it's part of the hedging things that we're seeing as well, too. What's
Yeah.
beautiful about futures is we get to see attitude. We get to see that attitude going out as you observed, is a normal inverted,
Yeah.
backwardation.
Yeah. Anyway,
Yeah.
Dan, I greatly appreciate you spending time with us this morning. As usual, I learned an awful lot. And so thanks for being with us.
My pleasure. Thank you for having me. And I'm looking forward to our paths crossing again. Always good to
Oh,
be with you, Jim.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.